Welcome to another episode of the Bank Free Blueprint Podcast. Today I have with me Robert Barr. Rob is with Good Steward Capital Management. He is a SEC registered investment advisor for several real estate funds. He's a fund administrator, manages over $150 million worth of assets based out of Tucson, Arizona. Welcome, Rob.
It's good to be back with you again. Hey, Tom.
Yeah, so thank you for joining us. Today, what I want to do is cover some things that passive investors might do. What are some options that passive investors have? So in real estate investing, there is a passive side of the equation, active side, and some of our listeners are people who maybe don't want to necessarily own the real estate themselves. They maybe don't want to be lenders in the real estate directly, but want to talk a little bit about options that investors have when it comes to real estate funds, REITs, that type of thing. So could you start out just by describing a little bit about the different options? There's lending funds, there's equity funds, there are REITs, that type of thing. So if you could give a broad overview of that.
Sure. So first, of course, active investors normally look at or think of as somebody who's actively taking their cash, buying real estate, maybe even actively lending on the real estate, but they're actively participating in the transaction and managing the transaction. So on the passive side, that's really somebody who's coming in and putting up maybe cash and making an investment, but they're really kind of hands off. Right? They just passively kind of let things ride, but aren't actively involved in it. And so knowing that there is always somebody who's active, then that's really how we start to define the methods in which a passive investor might participate. So a lending fund, for example, has the active managers of the fund who are actively participating in the transaction, and then the investors who are pooling their money together into that fund or that pool. And there are different ways to pool those monies together. I mean, you're aware of how we've used a specialized lending trust to pull it together, certainly an LLC or a fund and different models to do that. But essentially that money is pooled together, and those investors are all passive. They're just hanging out, letting the active manager do their job of investing it. And so you've got then REITs, for example, that generally there are mortgage REITs and equity REITs, but the vast majority of the time when we talk about REITs, they're an equity REIT that literally owns the real estate. So there are many REITs out there that own apartments or own commercial office buildings, and they're really designed to own that real estate primarily. Whereas lending funds tend to pool the money together and then use the funds to do liens, right? To do loans with a lien on the real estate. So mortgages or deeds of trust. So that's kind of the short version of it. I mean, people can participate in those in different ways. But the bare essence of it is that passive, let's put some money and let them ride. And you could think of it like maybe a mutual fund that you might invest money in the mutual fund, and it's the investment manager for the mutual fund who's actually trading and buying the stocks and moving those around, and you're just kind of there for the ride.
Sure. One of the main reasons for investing in a fund is diversification, and being able to have money in multiple projects rather than individuals. So that's one path. The other path is you just mentioned there's real estate equity funds and there's lending funds. On the equity versus lending, do you see advantages or disadvantages, benefits of one over the other?
So equity funds, so the equity fund, of course, again, what that means is that the money's pooled together and the fund owns part of that real estate. Now, there are some advantages. There can be tax advantages to that. For example, the real estate's going to have depreciation, and that may pass through to the equity owners. through the K-1 when it files its taxes. So that can be an advantage. But one of the disadvantages is that you own the property. And so if it needs financing, your pool is the one going out borrowing money. And there are some hybrids, like we do a lot of hybrid transactions, but essentially that's the root of it. If you're an equity fund, you're invested in that property, in that real estate. You are part of the owner of that real estate. And so when it borrows money, it's got to reach out to a lender, and that lender has a lien on your real estate. Again, it's passive. You're a third, party removed, but it's your real estate still. And so they have a lien on that. Whereas in the lending fund, you're on the other side of the fence, right? You're putting money up and you've got a lien on the property, first, second position, whatever it is, and can always take that back and liquidate it. So those are kind of the differences. There's an advantage. There are advantages on both sides of it, but that's a short. There are hybrids, like we do some hybrids where we'll do a loan and then take a portion of the equity also. But of course, it's a smaller portion of the equity.
Okay, so that by taking a part of the equity, I believe you mean taking it's sort of like a profit sharing structure.
Sort of like a profit sharing structure, exactly.
Yeah. Okay. So we have diversification, whether it's a real estate lending fund or an equity fund. Diversification meaning that the money that's invested is in multiple projects. So if something happens with one project, then there's the diversification of the others that will help stabilize everything that's within that fund. The other one is capital efficiency. When investors are investing in individual deals, there is the downtime in between a deal when the capital that's being invested is not being used. And so that has a tendency to draw down the overall return. If, for instance, you're lending, let's say for 6 or 8 or 10 month periods, and then there's a month or two in between lag time where the money isn't being used, and then you get back into another deal, there's that downtime where that capital is not earning money. So those are two of the things. The other one is, you mentioned the profit sharing model. Now there are some funds, and let's talk with lending funds. There are some funds who do just regular lending, and then there are some that do the lending with that profit share on the back end. Can you anything you want to share on that end of it?
So I think that first I want to go back to a little bit about what you're talking about with the diversification. I often describe it to that one-to-one, many-to-many, many-to-one type of discussion. And so you've got, certainly you can be an investor and say, here, I'm going to loan you some money. And we see that a lot in Good Start Lending Services on the lending side, because we have investors that are just hard money lenders. And we'll put together a deal for them, a house maybe here in Tucson or something, and they are the sole lender on that property. And they are, we're simply acting as a broker. And they put the money in, they are the lender in that. It's a one-to-one relationship. And what they like about that is they feel like they can kind of kick the tires. But the downside to that, of course, is anything that happens in that one house, that one transaction, has a complete effect on them, right? It has a direct impact to them. There's no diversification. It is a direct impact. If something happens to that house, then it affects them directly. Versus that many to one relationship where maybe you've got several people pulled together and they're invested in one transaction. Now, again, one thing happens in that transaction, it affects everybody. But, at least you're not the sole person involved. So maybe you've spread your money out in some other areas. At least you're not the only person involved. If it's $100,000 and you got 10, well, that's better than having your whole $100,000, entire $100,000 in it. But the many to many relationship is that where you get a lot of people together in a pool over multiple projects. And while one thing might happen that has an impact, you're diversified over all of those transactions, right? And so it can really, help protect and create a little bit more security. But where that really relates is as we talk about the capital efficiency, right? And sometimes I see investors who get excited. They're like 1-to-1, and they think, well, I can do this one loan and I'll make 12% interest, and maybe I can make some other points on it and do other things with it. But what's often not taken into account are two things. Number one is that anything that happens over here is going to draw down your return. So what you think of as 12% on paper could actually start to drop as you've got a lag in payments. You might have a lag in the overall return because it can't pay back all of its interest. Different things that can affect your return there. And again, one of the important things that I see is where the loan is going and it's active, it's fine. But then as interest reserves become a problem, or the borrower is not yet, he doesn't have the cash himself to make payments while he's doing a rehab, for example, well, now you stop getting payments. And you don't want to foreclose because the project's fine, it's going to work out, and he's finishing the rehab. Maybe he's waiting for occupancy from the city, or who knows, whatever. But you look at it and you say it's not really a bad loan. It's just not making payments right now because the borrower doesn't have the cash for it. So now you've got a drop in your income, right? Which can have a negative impact for some. So that's one thing that can affect your returns. So then you got the capital efficiency side that says maybe it's fine. Maybe the loan works fine, but it pays off. Now you got to hold the cash while you're waiting for another deal, another transaction. And so now you got capital lag. And so what you initially think of on paper as maybe being a 10% return, but then when you really average it out, taking into account the 1 or 2 months that you're holding cash, then your return starts to come down. And so that can have a negative impact on your overall returns. So the nice thing with a pool,
and then there's also the amount of time that one wants to take in vetting an individual project. And some people are more comfortable being able to see that specific project and put the time and effort in that it takes to make sure that's a good, solid project. And some people would rather see the more passive, let me put it someplace where I know it's going to be secured by real estate. Let me put it with someone who knows what they're doing, and let it be more passive.
Mm-hmm. That's right. And of course, again, that's the active passive discussion. You have those who are super comfortable with it. They know how to underwrite it, or they have a good team of underwriters. That's fine. And then you have those who really just who can trust somebody, who has a relationship with somebody that is the active manager of it, right? The fiduciary responsibility of managing it. So I think that what I have found interesting enough is that often with a larger, more experienced sponsor, the person who's actively involved, the returns are not that different. There's not a huge gap. It's a little bit, there is a gap, but it's not a huge gap, right? I mean, I've still seen returns overall to investors in a pool that, in a lending pool that still earn 10%, 10 to 12%. Now, it's not.
Yeah, that's great.
It's still a great return. Now, you can go directly into a deal and maybe earn 12 to 14%. But again, you're having to actively participate. You have a different risk because it's in one deal or several deals, but it's that direct relationship. So even still, I'd say that it's worth considering for people who really, want to be passive. the pools are.
Okay, so let's say that let's say I'm concerned about my retirement account, my retirement funds, making sure I have enough to retire on. I've got some money sitting. What options do I have? Now, we talked about equity funds or lending funds, but what options are there from let's say a retirement account perspective? Could you describe what options there are?
Sure. First, I want to go back and say that one of the beauties of the pools with real estate and retirement plans is the retirement plans have a longer horizon usually. So your time horizon, if you're younger, under 50, under 55, you've got a longer time horizon also. So any sort of lag in payments or any of that stuff has no impact on you. You don't care, because it's all related to the retirement plan anyway, as long as you get the overall return.
Mm-hmm.
So that's important. I mean, that's super helpful, especially when it's invested in a real estate fund, because the pool itself is diversified, but it's usually making really good money on it. Also, I mean, it depends on the pool, of course, the managers, but historically they do pretty good. The types of investments as a whole, generally speaking, it's considered an alternative investment. And so most retirement plans, as I'm sure you know, are managed by a custodian. That custodian is usually related to a broker-dealer. And the broker-dealer is incentivized really to invest through simple transactions that they often make commissions on. I mean, this is just the reality of it, right? Simple transactions where it's buying stock, maybe it's buying into mutual funds. Most 401ks that people have maybe are through Fidelity, and they've got a limited pool of investments. And they're almost always time horizon. They're saying, are you going to retire in 20 years, 30 years, or 40 years type of investments. And all it's basically saying is, we're going to buy a bunch of mutual funds over here. When you reach a certain time horizon, we're going to reallocate that to more bonds, less equities, less stocks, and then switch it again as you get closer to retirement. Super simple, easy for the custodian to report to the IRS and for them to manage, but not actually friendly for returns or the alternative investments. So that's where you have really two things. You can go that route, but that's going to limit your pool of investments, your choices of investments. On the other hand, the IRS doesn't have a rule that says you can't invest in the alternatives. It just doesn't make as much money for the broker dealers. And that's where you start getting into self-directed IRAs and the various types of IRAs. And also, quite frankly, self-directed 401ks, which are becoming much more popular nowadays. And what's interesting to me is the broker dealers have kind of built a culture that makes people think, investors think, that it's a requirement that you have your IRA or your 401k with a broker dealer. And of course that benefits them, but it's completely inaccurate. The IRS doesn't care at all. It doesn't make that distinction, which is why you have so many solo 401ks and self-directed IRAs and all of that, because the IRS has nothing to do with it. And there are a lot of good IRA companies out there, custodians that do self-directed IRAs, and which allow you to then invest in notes, even unsecured notes, and of course promissory notes that are secured by real estate, but also be able to put it into real estate funds and others. Now, what I want to be careful of is there are a few custodians that do allow for investments into some real estate funds, right? but they're few and far between. I mean, I happen to work with one that I've got some of our funds are on their platform. So if you work with that broker dealer, you can still purchase those, but they're few and far between.
Okay. Okay. And so let's say that I do have funds with Fidelity or whoever it might be right now. Is it something where I can switch over into a self-directed IRA, and what is the process to do that?
Sure. So again, there are two options. The option number one is which really limits the investment. So as I say this, I want to be clear that it limits the investments. But if you're least active, it's not a bad way to go. So you got an account with Schwab. You can roll that into an account at like our custodian, which then we can invest in some real estate, real estate funds. Mm-hmm. And that's a simple transaction. That's the easy transaction. It's a broker-dealer account to a broker-dealer custodian. Very simple, but you're not going to buy real estate with that account either. But it does open the universe up a little bit from stocks, bonds, mutual funds to some other alternative investment. So the universe opens up a little bit more in choices by doing that. And there are a lot of people I encourage to do that because they're never really going to keep buying real estate or do anything else. They're going to stay in these couple of funds that we manage, and that's simple enough for them. And it's the less expensive route to go. But then for others, it makes sense to then go to an IRA custodian, a self-directed IRA custodian, like, not that I'm trying to endorse anybody here, but there are several out there we work with. So Vantage IRA is one, and they're very, very used to this. IRA Trust Services is another custodian that's really used to doing real estate and other types of investments. There are a couple out there that start with E that I'm less crazy about because I think they're very difficult to work with from a new investor perspective. But the vast majority are really good to work with. And essentially, you open an account with them, you roll money from your broker-dealer based account, literally fill out a form that says, I want to roll it over, and you roll it into the new account. And then from there, you begin to make the investments in the other alternative.
Yeah. Great. And one word of caution, I guess, too, would be, and maybe you can expand on this a little bit, would be to make sure that you aren't taking possession of the funds in that transfer, or at least for a very limited period.
Yeah, I mean, there's a rule that says that you've got a window you can do, and I don't want to commit to the details of this, but you have essentially a 90-day window where one time in 12 months you can move the money out for the purpose of transferring it, right? It's not because you're going to use it and then turn around. That's not what it's designed for, right? It's to be able to move it out and transfer it to another qualified plan. And I think that one of the things that happens in the investor's mind, often that IRA money is their money. That's how they think of it, as being their money. And the IRS sees it as two different entities. They see your money and the IRA money as if the IRA is its own person, right? And that's also an important way to look at not dealing in any transactions that are prohibited too, because if you think of it as my money, as your money, you're more likely to actually get into trouble or do a transaction you don't mean to. But if you realize it's the IRA's money, it's a separate independent entity, and I'm simply a fiduciary that takes care of that money, but I'm not going to receive it, then you're going to be better off in managing it also. But the same is true for that transfer, right? Thinking about it, realizing it's not your money yet. It's a separate
Yeah.
entity of money, right?
Got it. How about someone who has been working for a company for some time and they switch to another company? Let's say the 401k does not follow them. What do you have for advice, if anything, for someone who may have a 401k that is with a previous employer?
Sure. So first, I want to address a real problem that I see sometimes is investors think of diversification as having more than one account, and that's just absolutely not true, right? And let me dive in a little bit, because what happens is most 401ks are managed by only a handful of broker dealers, and all of the allocation is nearly identical. So even if you've got a Fidelity 401k and a John Hancock 401k, if you really looked at what the allocation is, they're going to be pretty close. You know, if you're 30 years from retirement, it's going to have a list of stocks to be in, and you're going to look at the two and say, yeah, these are kind of similar. Maybe not the same, but pretty similar, right? And so what happens is you end up with a 401k at 2 or 3 different companies. I mean, literally, I have a client who's rolling over from 3 different companies. And if you look at all of those, you're not getting any diversification. What you're getting is a lot of money in almost the exact same things, right? So it's not really adding any benefit to it. But of course, that money is also limited to whatever that custodian or whatever that allocation is for that 401k. So I always honestly suggest that people should open your IRA, roll that money every time you leave a company, roll that money into that IRA. And then that IRA you can make your choices of what it is that you're going to do. You know, are you going to invest in maybe some alternatives, real estate or something else, or into a different allocation of stocks, bonds, mutual funds, right? But don't allow the 401ks to sit out there at these older companies, right? Move it in, move it out, move it out.
Mm-hmm. So when that's being done, and this one I'm not sure of, does the person that has control of that money, or their money, I guess is how I would say it, is it the holder or the recipient, like the plan administrator or the IRA custodian that is contacted to make that transfer? Or is it the company itself?
Yeah, so usually in most cases, the 401k, it's really not the company. If it's large enough, the HR department might have somebody who kind of works on it, but as a whole, it's the plan administrator. And in your 401ks, there would be a phone number to call that basically completely bypasses the company, because the company actually doesn't have any control over it, right? But you log in, you get a hold of the HR department, and you just say, "Look, I want to talk to the plan administrator or to do a rollover," and you just make the phone call. Also, when you log in, most of the big plans have a form online that you can fill out, or at least a PDF that you print and you fax in or scan and email in. That's super common nowadays, so it makes it really easy.
Okay, great. So if somebody wants to get more information about whether it's how to make the transfers, how to set up accounts, or just advice in general, is that something that they can reach out to you for?
Yeah, that's never a problem. Our website, of course, is goodstartcapital.com, and we also have an information site that is goodstewardinsights.com, which has a lot of information. The other thing before we get too far along is I think it's worth noting how a solo 401k can benefit somebody, right? So what's interesting is often we think of 401ks as only being beneficial to the owner of a company, right? In other words, I have to actually own my own company before I have the 401k. And while that is, of course, it's technically true, there's certainly a strategy out there that reminds us that if you have a side business, and maybe that side business is related to investing in real estate or doing something, and then you've got this other job over here, that doesn't mean you can't have a 401k. And you can have that solo 401k that's self-directed, that you're the administrator of, right? You don't have to go to Fidelity or somebody else. You can be your own administrator for that plan. And now, while contributions to the plan are limited because you're limited by the IRS rules across the board. So if you've got another 401k because you're working for a big company, the contributions over there affect how much you can put in this one. However, what's important is that once you have it established, and even sole proprietorships can establish a solo 401k, but you don't need to spend a lot of money on a big company. Once you have that solo 401k, you can roll money into it. So old 401k plans can roll into this new one of yours. Other IRAs can roll into that solo 401k. And so it's worth noting, because the contribution limits are higher, especially if you are an active business making money. And of course, your personal control over the funds is actually greater also. So it's worth talking about. It's something that has to be considered, and as part of a question to consult on to see if it fits for somebody. But it's that difference between the custodian IRA, very passive, being managed by one of the broker dealers, to maybe a little bit hybrid, something at one of our custodians where you can still invest in the alternatives but not too much work, to the self-directed IRA where you're passive. You can still do passive investments, but you are making the choice. I'm going to buy a piece of real estate, or I'm going to go into this note or something. And then you got this other area that is your own solo 401k, and the advantages to that.
Okay. Yeah, that's a great overview. What, when you, as a registered agent or registered investment advisor, when you are looking at different funds, or when I'm looking at funds, or our listeners are looking at certain funds, what are some of the things you look for in a fund or a fund management company that will help you determine whether you're making a good decision or not?
Sure. So history, obviously has impact. So history matters, and not history of the individual fund. That's actually not really that critical. That doesn't really have any, it doesn't really matter that much. What does matter is the people behind it. So how long have they been in that, that area, that business? Most sponsors of funds have more than one fund. So they might have a fund which then closes out because they've reached their maximum or whatever, and they start a new fund. So the fact that that's happening, that's not important. That's common. What's important is what's the history of the people. So that's certainly part of it. Probably the most important to me is their failures. And I think we probably heard this before, right? If they're trying to hide their failures, that's not really good to me. And not because they had failures, but because I want them to acknowledge the failures, right? I deal with a lot of large institutional investors, family offices and such, right? They've all made mistakes. The issue is never about whether they made mistakes or any of that. It's about how do they handle those mistakes in the future. That's much more important. I actually want to know what those mistakes are. It's okay. If you had a property that lost money, that's okay. But what did you do about it? Right? Well, how do we deal with it in the future? So I think that's probably one of the more critical things to know. And if somebody didn't have a failure ever, that's a red flag.
Yeah, transparency and openness and communication and management team, I imagine all of those.
All that matters. That transparency is really important.
Got it. Good. Any other bits that you'd like to share as we wrap this up?
I don't think there's a whole lot right now. I mean, I could probably spend an hour on retirement plans, right? Mm-hmm. I think that one of the things that is critical that people should kind of understand or get an idea of is retirement plans really allow for a great tax advantage. And I think people miss that. Open the IRA, have the IRA and other retirement plans where you can get that tax deferred, or even in some cases like a Roth, where there's no taxes on that earnings in the future, is going to add up. And there are lots of calculators out there on the internet where you can kind of calculate and figure it out. But if people aren't using a retirement plan, they need to really consider the advantages of using that retirement plan, because there's nothing better than compounding interest without paying taxes. I mean, come on, that's great, right? But I think it's
huge
often
effect.
overlooked.
Okay. Great. Well, thank you, Rob. I really appreciate you taking the time, and this has been really good, valuable information. And one more time, if somebody wants to reach out to you, or if they want to get a hold of your newsletter or talk to you, whatever, how would they reach you?
Yeah, so they can go to Good Steward, STEWARD, goodstewardcapital.com.
Okay, great. Well, thank you, Rob, and looking forward to another interview soon.